All right, well, we'll go ahead and get started. Welcome, everyone, to the Arrived Q1 Financial Performance webinar. If you haven't had a moment, please review our risk disclosures, and we'll go ahead and get started here. Welcome to the Q1 2025 Financial Performance webinar. Our speakers today are Ryan Frazier, our CEO and co-founder, Cameron Wu, our VP of Investments, Jake Pruchno, our head of operations, and then my name is Korin Hedlund, and I lead our investor relations team. A quick agenda so you all have an idea of what to expect today. The team will walk through Q1 2025 highlights, what performance looks like for all investments on Arrived. This is both individual properties, our long-term rentals and vacation rentals, our fund investments, which include the private credit fund and single-family residential fund, what dividends looked like in Q1, our new Arrived evaluation, and then Ryan will walk through our roadmap. And then we will jump into Q&A. For folks that are new here, feel free to drop any and all questions in the chat. We will either answer them right in chat or tee them up to answer live after prepared remarks. For the questions today, it'll also be focused on performance related. We also have an intro webinar that you can attend at any time. And with that, I would love to invite Cameron Wu up to the stage.
All right. Thank you, Korin, and welcome everybody. Appreciate everybody's time and attendance. And let's talk through some of the Arrived investment performance. So today we funded 455 individual properties with over 257 million invested on the platform. In the private credit segment, we have completed 67 loans. So since we've started this in May of 2024, we have already had 67 loans successfully pay off and have over 50 currently in the portfolio. And we have 56 properties in the single family residential fund. And to give you a visual representation of the spread of all of the assets, here are our assets. The blue dots are going to be homes that are located in those markets, and the yellow ones are the loans that we currently have in the portfolio. All right, so let's talk single family residential, both individual properties and fund. And for those of you who are just still orienting around some of the terminology, single family residential typically refers to both an operating model implicitly of a long-term rental, but more specifically, it is the asset class of a detached single family residential home, a single unit traditional home on a single lot. And that has been our primary investment product since we started as a company. And then we expanded to vacation rentals using the asset class of a single family residential, but then having a different model on top of it to generate income. And we'll get into that in a second. So first, on the individually owned properties for single family residential, we've had 95.2% stabilized occupancy as of Q1. So this was a really great quarter for us. We are in line with the large national rental operators' levels of occupancy. We've seen strong rent growth with over 70% of our portfolio that has leased at or above our pro forma rent expectations. We had 44 new leases starting Q1, and this is when leasing season really starts heating up. After the slow holiday period, call it from Thanksgiving through the end of the calendar year, January starts thawing. People start hitting the market a little bit to see what kind of rentals are available. February starts picking up. And then once you hit spring break, really starts taking off in terms of demand. So we're currently managing that ramp up and that strong leasing season right now, but I'll get to more about that in a second. And then 30 of our leases are above forecasted rent in that period. For the single family residential fund, those 50-ish specific properties in that SFR fund, we have over 21 million total invested in that investment product with over 19,000 individual investors. We had 99.3% stabilized occupancy in that period on a population of 51 properties. So we have 56 now, but for the purposes of measuring the Q1 results, it was measured against the 51 properties that were in the fund at the time. We've added a few since then, which is the 56. But 99.3%, it's a great number. There was one property that went through a turn. It leased back up quickly. So that little bit of vacancy dropped the average, which was at 100%. But, like we say in the business, if you're at 100% occupancy, you're not quite maximized in terms of your revenue optimization. But with the SFR fund, we've kind of already gotten through that period, and we have a smaller portfolio that we like really look at carefully. So, we're at that high occupancy percentage, but, we're not complaining about it. For us, our view is that occupancy is king, and the less vacant that you have your units, the more cash flow you're going to generate. Even if you leave a little bit of rent on the table, we'd much rather keep an occupant in the property, get them nesting, and be a very long-term tenant. Okay, so vacation rentals, much like long-term rentals, we are heating up. Once that spring break season hits, we really start seeing bookings pick up in January and February. People start planning their vacations out about 30 to 60 days that we usually see. A little bit further out for larger reservations. If they're going to stay in a larger property for a week, that actually might be a $5,000 reservation. So we see a little bit longer lead time, but we really start heating up in the first half of the year, and this extends out through about fall time. So with vacation rentals, we had $656,000 of gross booking revenue from all of our vacation rentals. Really high ratings, great operators, both internally as well as our property management partners. We had a 4.95 average guest rating across all of our properties, 39 total bookable, and 26 total markets. And kind of most notable, if you see on the prior slide, the buyer's house, we actually own the original house that was used in the filming of Stranger Things, the buyer's family house. And we recreated the set and did it really well. And it's been a very successful vacation rental. So we're really excited about season 5, the last season that's scheduled to come out sometime in the later half of 2025, we think. But a lot of hype starting to build around that. And with that, we're hoping that the vacation rental will get some natural press and get a nice lift from that. All right, private credit funds. So this is our most recent investment product offering. So it's been a great success. In the last year or so, we've gotten over 40 million of total invested in the private credit fund with a consistent 8.1% annualized dividend yield, not only generated in Q1, but generated since inception. We added 31 loans, and there's over 15,000 investors in that private credit fund. So we've purchased over 120 loans at this point, at which 60 plus of them had paid off, as you saw in the prior slide. And just to give you a little bit more information about what is composed, what is the private credit fund composed of in terms of assets, there's a couple of different loan categories within there that we buy. Mostly within what we call the residential transition loan space. They're typically short duration, 6 to 24 months. It can include primarily business purpose loans. So they're going to be loans for entrepreneurs within real estate. So they're either flipping properties, they're doing ground up construction. They may be doing horizontal land development to get the permitting, the entitlements so they can do vertical construction. And then there's bridge loans also, which there's not really a construction component. They're just looking to bridge from point A to point B. Maybe they need to borrow some money as they're financing another property, they're buying another one, but they're selling the current one. They may take out a loan on the one that's for sale so they can go buy the next one. So there's all sorts of reasons for investors to have bridge loans, but those are the primary types of loans. And bridge loans are going to be shorter in nature. If they're owner occupant, like you want to sell your house now, but buy your next house and kind of orchestrate that timing. That's called owner occupant bridge. Those will be outstanding for about 3 months. Business purpose bridge will be about 6 months. Flipping can be about 6 months, and ground up construction will be 9 to 18 with the sale period. So we have a nice distribution of different credit types, all high yielding, all short duration within that credit portfolio. And that's how we're able to generate the 8.1% annualized returns with 0 defaults so far, and kind of really a high turnover and really nice diversification of risk across the country. You saw in that first graphic the distribution of the loans and the properties across the country. So even our credit products are very nicely distributed across the United States. So diversified in borrowers, diversified in who we're buying the loans from, diversified in price points and geography spread. So it's a really well-constructed portfolio that we're pretty proud of. But just wanted to give you a little bit more insight into how is that constructed, what is making up those $40 million of assets. All right, so what are some of the investment product focal points of what we're looking at? So I alluded to some of this, but in single family residential, we're really focused on hot leasing season. We have both a lot of expirations as well as a lot of anticipated leasing that's going to be happening. So we tend to stack our expirations of leases during the hot season. And we want to pull it forward even more to mostly February through April, where people are having their lease expirations. The rationale for that is that rentals is a very seasonal business. So when a lot of people are looking for rentals at the same time, the price can stretch pretty quickly for a short period of time. That short period of time is going to usually be spring and summer. So the bonanza is usually from about March through the end of July is when you can really get your peak rents. So we try to have our expirations happen at that point, because if a resident does choose to leave, which we work with them to make sure that they don't with pricing, and we're very flexible with that. But if they do end up having to leave because of life reasons, then at least we're in the season where we can get higher rent. So managing the orchestration of expirations, fast turn renovations, and releasing at higher rents, that's the opportunity that sits in front of us right now that we're looking to capitalize on, and focused for both individual properties as well as fund properties. Within vacation rentals, similar, capturing demand. We've got a lot of properties in beach markets, so in Florida and kind of coastal Carolina area. So we generate the lion's share of the revenue during those months. So making sure that we have the right reviews, the right operations in place, and turns are happening fast. There's like back-to-back reservations that are happening all the time. So in order to maintain 5-star reviews, strong pricing, and deliver on the guest operations, the vacation rental team is like very much on the ball right now for these like highly seasonal periods. And then private credit fund, we've done a really good job this quarter of getting really high quality supply. We had the max, the private credit investment limit, the maximum investment amount at $5,000 per investment account per month for about 4 or 5 months as we were building up that high quality supply. Now we're seeing the fruits of those labors, where we feel really good about the origination partners that we're working with. We have a well-defined buy box with a good niche of loans that we feel is very versatile, even in uncertain economic times. So what does that mean? You tend to opt towards higher net worth borrowers and lower LTV loans, meaning lower loan to value ratios. So that way, if there is a dip in housing prices, if there's a slowdown in the economy, there's still a lot of buffer, both on the project side as well as backstopped by a high quality borrower. So that's where we're focused on, and keeping that supply available so we can unlift the max for a longer period of time, invite as much investment volume, but be able to serve that investment volume with a high quality supply. So I wrote some market outlook commentary, kind of at the end. I know that there's a lot of macro news going on, so I'll probably, reserve that till the end. I'm sure there'll be questions about that. And you can check out the longer statement within our Q1 earnings, but I'm going to go ahead and invite Jake up to the stage now to go over the financial results.
Perfect. Thank you, Cam. So now we're going to talk about how all of that operational performance translates into returns for investors. There's 2 types of returns you get when you invest in real estate. There is the dividends, which is the cash flow generated from renting a property out, and the appreciation, which is the change in value of the investment. Now, the dividends are considered realized returns because it's actual cash that's deposited into your Arrived account each month, where those funds can be reinvested or withdrawn. The appreciation is unrealized because we haven't actually sold the property and distributed those funds. The value of shares that you own may be higher or lower than the initial investment value, but ultimately the appreciation will become realized when we eventually sell the property and distribute cash to investors, or when you sell your shares on our upcoming secondary market. So we're going to go through the dividend side of that returns equation first. The Arrived dividends are paid out monthly, so investors receive consistent cash flow from their investments. Over the last 3 months, we distributed over $2 million to investors, and that brings us up to $12 million paid out all time. Dividends are a big benefit of investing in real estate because you're able to lock in some investment returns now, even while you're still looking for that long-term appreciation. Now, this chart is showing the annualized dividend rate for all of the individual properties based off of their first quarter payments. It's a good snapshot of current performance across properties, even if it doesn't fully encapsulate their full performance since inception. Remember that when you make an Arrived investment, you're investing in that specific property. So you earn the dividends and appreciation of how that specific investment performs. If you only invest in one individual property, you effectively have all of your eggs in one basket. You may end up investing in a property that crushes it by outperforming on rent and having minimal vacancy and expenses. But you also may invest in properties that have unforeseen expenses, which cause us to lower or pause dividends for that particular property. That potential variability in performance is why it's important to diversify. Now, this is the exact same chart, but it also now shows the dividends paid by our two funds since their inception. Unlike the individual properties, the fund's dividends tend to be stable over time. And that's because an investment in a fund is diversified across all of the assets that it owns, which provides some investor protection. Our single-family residential fund has over 50 properties within it. So if one property within the fund isn't rented, it doesn't have a material impact on the total cash flow that that fund is generating. That's why the single-family residential fund has been able to pay out a consistent dividend of 4% every month since it launched. The private credit fund is really similar since it's a big collection of different real estate loans. That fund has paid a consistent 8% dividend since it launched last May. Its dividend is double that of the single-family residential fund, but remember that it doesn't have an appreciation component the way the single-family residential fund does. The trade-off with that private credit fund is that you're able to generate higher cash yields right now, but you likely won't earn any long-term appreciation. And speaking of, let's talk about appreciation. Appreciation is the other way that investors earn returns on their real estate investments. While we operate each property, we estimate the unrealized appreciation by revaluing the asset each quarter. We used to call these estimates a share price, but we're now calling them the arrived valuation. This is largely because we have our secondary market coming up soon, and we want to draw a clear distinction between the price per share that you might transact at on the secondary market and the arrived valuation. Despite the name change, the general meaning is the same. The arrived valuation represents Arrived's opinion about what each share in a particular property is currently worth. To create the Arrived valuation, we start by estimating the property value. This estimate represents what we think we'd be able to sell a property for in today's market. It's similar to looking at the Zillow's estimate for a particular property. For the first time, we're now showing the property value estimates for each home inside your portfolio as well. This lets you track the estimated appreciation of the specific property compared to its original purchase price. The property value isn't the only factor that goes into the Arrived valuation, but it is by far the largest. We're highlighting the property values now because it's a great way to track the appreciation of a property like you would on Zillow. Now, like I was saying, the property value is the main input into the Arrived valuation, but the Arrived valuation also includes the other assets and liabilities within the LLC that owns that property. That means the Arrived valuation factors in things like the cash reserve balance, any outstanding loans, and amortized expenses. Ahead of the secondary market, we also made some smaller calculation changes to how we estimate the Arrived valuation. And the granular details are available in our recent Q1 financials blog post. Like any real estate investment, appreciation tends to perform better over longer periods of time due to the upfront expenses and transaction costs inherent within the asset class. Tracking the property value appreciation can often be a leading indicator of the Arrived valuation appreciation. So now we're going to look at the combined performance, dividends and appreciation by specific asset type. I'm going to highlight a few things on this table. So you can see the individual single-family residential properties had an average dividend of 4% per year this quarter. That's a simple average that combines our brand new properties with our older ones and includes all markets. The average appreciation for those properties was up 3% over the last 3 months. Now, you'll also see that the single-family residential fund had an annualized dividend of 4%, virtually the same as the individual properties. The single-family residential fund is just over a year old and owns over 50 properties. And our acquisitions target for that fund are really similar to the individual properties. So it makes sense that a collection of properties in the fund has the same dividend as the aggregate grouping of individual single-family home properties. Again, we see the private credit fund at that 8% dividend mark. And again, while it's higher than these single-family investments, keep in mind that there's no expectation of long-term appreciation within that fund. Nearly all of the private credit fund's returns will come from dividends, whereas the single-family investments are likely to have half the returns come from dividends and half the returns come from appreciation. Now, here's a look at the total gross returns since each property had its first public offering. This is showing the combined returns of both dividends and appreciation. And importantly, this chart is not annualized. So properties that have been owned for a longer period of time have had more time to appreciate and made more dividend payments. You'll see there that the properties on the far left are near 0%. And again, that's because they just launched. They may have only paid out their first few dividends, and they haven't even had their first arrived valuation update yet. And I want to draw specific attention to this dot over here. This dot is the Centennial, which was the 18th property ever IPO'd by Arrived. We sold the Centennial in October, which makes it the first property to go through the full investment cycle on Arrived, where investors bought shares in the property, collected dividends for 3 years, and then received a return of their capital plus appreciation. Investors in the Centennial ended up earning nearly a 35% return over 3 years for an average annual return of 11%. Of that 35% gain, the majority actually ended up coming from appreciation. Now, we just had our 4-year anniversary of our first properties launching to the public, and it's likely that over the next year, we'll begin to evaluate more of our older properties for a potential sale, especially since they've seen strong estimated appreciation growth so far. And with that, I will pass the baton off to Ryan.
All right. Thank you, Jake. Thank you, Cameron. Now that we've run through the operating performance for the first quarter and the impact on investment returns, we want to talk a little bit about what our product strategy was in Q1, what we focused our attention on for everyone, and what we're focused on in the quarters ahead. So really to start, one of our bigger focuses in the last quarter was really leveling up all of the information available to investors in their portfolios. As investors on Arrived are creating larger portfolios and more diversified portfolios, it was important to us that they had more ways to understand the performance of their portfolio, also to understand the allocation of their portfolio, and maybe where there might be opportunities to diversify further or change some of the mix of their investments. So to start, we've added some additional elements behind the Arrived valuation, so investors can see what's making up that Arrived valuation. The big item that we introduced this quarter was property values. So now investors can see what is the estimated property value that we're using as an input into the Arrived valuation, and over time be able to track the trend of those property values to see what the direction that that property is moving in or that market is moving in terms of property values. The next item is more of a breakdown or distribution of how people are allocating their assets into different asset classes. So we added this asset allocation chart, shows investors how they've mixed their portfolio between single-family residential properties, vacation rental properties, and then the SFR fund and private credit fund. And over time really helps investors see the breakdown of where they're allocated and maybe use that information to make decisions around where they might like to invest next. The next thing along that same line is seeing their asset allocation geographically across the country. So being able to see where your properties are and where they aren't to help figure out, are you allocated to the specific cities or markets that maybe you believe most in? Or perhaps for upcoming properties or opportunities to invest, seeing how that lines up to your portfolio. We'll talk a little bit about the launch of the secondary market that we're working on this summer, but that also represents an opportunity to invest in new markets that maybe were more prevalent on the Arrive platform in previous quarters or years, and be able to use that as an opportunity to further diversify where your assets are across the country. And then the last is something that investors asked a lot about, which is a more formalized monthly account statement where they can see a breakdown of everything that they own and perhaps use this however they may need for record keeping or sharing with employers if they're having to disclose their investments because they work in the financial services industry. But we now have a monthly account statement with a detailed breakdown of your assets. So that was really what we focused on in the first quarter. Again, more of a focus on more depth in investor portfolios to help them understand their allocation and maybe provide insight into where they might like to invest next. What we have coming up this summer is really the launch of our secondary market and the ability to buy and sell shares of rental properties on Arrive from other investors. Our plan is to launch this on a quarterly basis where once per quarter, investors will have the opportunity to engage in a week of buying and selling shares on the secondary market. This provides access to our older cohort of properties, which we're close to over 500 properties across more than 60 markets today that investors could participate in. And those properties could be ones like Cameron mentioned, the Buyer's House, a vacation rental property that was featured in the show Stranger Things, and really any of our vintage properties where investors can see the track record of their performance over time, or how that market has performed across Arrived, and decide if they want to participate. It also creates an opportunity for a sort of side door exit for investors who want to get liquidity earlier in the life. Perhaps they, invested in real estate because they're looking for a long-term hold, but they also want the opportunity to get liquidity if and when they need it. Perhaps sell a portion of their portfolio, or maybe sell shares in some of the properties that they invested in years ago that have seen a lot of appreciation, that they want to diversify into new properties or other offerings. So this is launching later this summer. We're close to, in the next month or so, more of our internal trading and testing there. And then over the next few months, we'll be sharing more on the exact launch time of the secondary market. This is something that the team has been really excited about, working on really hard for over a year, both on the regulatory side to make this available for investors on the platform, but also to make sure that we're creating a great product that provides or can provide quality liquidity for investors, an opportunity to buy and sell all of the properties on Arrived, and really excited for this to come. And so with that, that's all of the updates that we have for today around our first quarter performance, our product roadmap, and now invite folks back and we can do some Q&A.
Fantastic. Ryan, Cameron, and Jake, thank you so much for prepared remarks. For all the folks that have spent 29 minutes and asked some fantastic questions, we're going to jump into those now. Sometimes if I see I'll group them together, and then at the end, I'll just ask if I've missed any. Quick reminder for today, we're focused on performance, what the market looks like, and so on. So we'll jump in. Ryan, we had a few secondary market questions, and since you just walked through that, I thought it was a good time to maybe jump in on those. Ken has the first one. What is the thought process for only having the secondary market open for a week during the quarter?
Yeah, so as we were building the market, we really want to make sure that investors know when the market is open. And so we want to start with 1 week per quarter, really to create this time where it's a focus for both buyers and sellers to kind of come together and focus on the secondary market at that time. I think over time, as the number of investors on Arrive grows and the number of offerings that we have available changes, we might look to change the frequency. But for now, we think that's the right mix of getting everyone together at the same time to participate in the market, but also often enough to provide liquidity for investors. And you really learned some of that from our redemption program on our single family residential fund and credit fund, which also have quarterly liquidity windows.
Fantastic. A great question. Another one in here from Ken, which I think is fantastic. And Christina jumped in, who's our staff designer. But they asked, is there a non-live test area that investors can try out the secondary market features on, or will user support be via documentation?
Yeah, so the testing will be extensive on the Arrived side, where we're doing the testing internally. The reason is because the entire market, when we do launch, is going to be real transactions from investors buying and selling from each other. So we're doing a lot of work up front to make sure that works well. So really but we will provide a lot of documentation and education on how the market works, how to use the product. We've also worked really hard to get the user experience right and make sure that it's intuitive for investors to use. And I will say that that process has been in tandem with investors in the community as well, where investors who have raised their hand and said they're interested in providing feedback on the secondary market, we have had calls with them to provide feedback on the user experience in a non-live trading way. So there has been that product process, and if there's interest in participating in those types of things in the future, let us know.
Absolutely. I saw Janet Lee just asked, will there be a training video on the selling? Absolutely. Our goal is to have as many resources readily available for you all, and then open to feedback if there's other resources that you would like to see in the future. I'll say personally, our team's done an exceptional job at documenting everything internally. So excited to make that investor facing in the future. So more to come. Let us know if there's any other questions regarding secondary market. Happy to jump back through. All right, I'm going to go to the top of the queue from when they started, when you all had prepared remarks. Let's see here. Buster asked, what are the reasons for the slowdown in the new vacation rental acquisitions? When can we expect new offerings in vacation rental properties? Cameron, I'll kick that over to you.
Yeah, so like I said in the prepared remarks, the focus on vacation rentals has been optimizing performance on the existing portfolio, but why, right? What's the reason for that? So I think in 2023, we started noticing a bigger slowdown in like the overall market volume for Airbnbs and kind of that COVID era traveling. So what we find though is that despite the overall market shift in reducing demand as like discretionary income is tighter and tighter, the top slice of vacation rentals rake it in big time still. Like the ones with the best reviews, the most mature listings and good recent reviews, good quality photos, those still make lots of good returns. And we have many of those in our portfolio. What we're trying to do is elevate the ones that aren't at that top slice to that top slice, because that's where we believe where the vacation rental market is paying off right now. It's in a little bit harder mode than it was in 2021 and 2022 when everybody within there, was working remotely. So it made natural sense that that market was very elevated. So as it's gotten more difficult and challenging of a market, we're upping our operations on the existing portfolio. But that's been a strategy that's been intentional probably for the last 18 months or so. And even during that period, we have been incrementally offering like very select, well thought out, themed and amenitized vacation rentals that are internally managed. So you'll see a lot of them in the Scottsdale area. So you'll see the Beatbox. We had the Buyers that was launched around Halloween. We have the Solano, which is a really nicely designed like painting experience and like a really nice weekend getaway that's more than the average house. And we're finding that those are performing really well as we've been expecting. So the acquisition game plan is much more in step with that intentional, let's shoot for the top percentile, because that's where we're getting rewarded on the acquisition and like monetization strategy. So we've got another idea in the works. It's going to be kind of a bigger theme. So I'm not going to reveal what it is, but it's kind of like how we're approaching the vacation rental segment right now is let's think of a really good theme that matches the market. Then we're going to find the asset that is conducive to that in a like cost-effective way. Then we're going to launch that one and kind of try to accelerate the ramp to getting it to like very mature, stable performance. So that gives you a flavor of the types of like the lens through which we're viewing operations and managing the assets, but it's also why there's been a reduced volume of acquisitions. So once that portfolio starts really humming in a higher percentage of them are top percentile ones, we'll just have a better feedback loop on what works in which markets. But I think it just has to be much more intentional than what the market was rewarding 4 years ago.
Fantastic. Thanks for walking through it, Cameron. I'm seeing two questions regarding the private credit fund. And this might be a two-parter, Cameron. How much cash is not deployed in the private credit fund from Jonathan? And then I think there was another one in here. How much private credit funds are uncommitted or waiting to be loaned? The second portion here is, do we earn dividends on those uncommitted funds as well? Great questions.
Yeah, great question. So I'll start with maybe the easy answers and then go through a little bit of timing, just so you know how the process works of when do you invest and when do you start accruing returns on that investment amount. So fortunately, the answer right now is 100% utilized. So all of the investor capital that is deployed in the private credit fund is deployed into loans that are earning principal at the rates that we'd be expecting, according to the product mix I was describing earlier. As far as when do you invest and when do you start accruing the dividends? So you just have to meet the ex-dividend date of the prior month to start accruing dividends for the next month. And that currently is the end of the month. So for example, if you were to invest by tomorrow, then you would start accruing the yield on the private credit fund the next day on May 1st. So as far as deployed versus undeployed capital, we don't draw that distinction in the formula for calculating dividends, like who's eligible. It's all determined by the ex-dividend date and getting it in by that time to be eligible for that next month's payment. So that's how that part of it works, as opposed to having to keep track of, is money deployed or is it not deployed? It's more like, when is it invested into the fund? And then from that point, we split the economics.
Fantastic. Yeah, great questions. Let us know if there's any other details there. I'm seeing some other
I
ones.
think I'll add, there was a question, if we do have uninvested cash in the fund, are we earning interest on that? And the answer is yes. We earn interest on any uninvested cash. Typically, we'll hold that in mutual funds or in one of our high yield accounts with our bank. And so, we may hold cash reserves from time to time, particularly if we have significant upcoming potential draw requests from borrowers. But right now, as Cameron mentioned, we've been able to stay 100% or higher on utilization. And that's really, we've been trying to manage that alongside the amount of investment capital that have come in, where we've had the $5,000 per month max for a lot of the time so far. And then when we're able to get overcommitted on what we're able to fund, we've been able to remove the max investment for investors. So always managing that cash, but I think it's a good question on, are we earning yield on uninvested cash? And yes, the answer is we are.
Fantastic. I'm glad you caught the two-parter there, Ryan. Great question, Frank. And I'm seeing our team's answering a lot of great questions in the chat, so keep them coming our way. Lots of engagement today. Cameron, I'm going to put this one over to you. It's from Raul. What is your average purchase price to list price ratio when purchasing properties? With the market slowing down, are you considering making lower offers to maximize yield?
Yeah, great question. So the purchase price to rent ratio is a very popular kind of back of the envelope heuristic that we use to within the rental industry to approximate cash flow. So that ratio historically has been about 160 to 1. So that means for every dollar of rent that you generate per month, you would pay $160 for that in the purchase price of an asset. So a classic example might be, to get a $2,000 rent in a market, you might have to pay $320,000 to acquire that asset, say from a new home builder, which is actually, it's funny that those numbers, we use that as an example, because that is very, very close to what our numbers come out to be as far as what is our asset mix. It's about a $2,000 underwritten rent for a $320,000 purchase price in one of the smile states that kind of is the south to southeast and southwest part of the country that is experiencing larger population growth. So now the second part of the question, with the market slowing down, are we considering making lower offers to maximize yield? I think it's very market dependent. So certain markets, absolutely, we can offer lower than suggested list price and still win them. This is particularly true in areas that had a large amount of supply that they were building up. And there has been a bit of a macro slowdown in the building market where inventory has been accumulating. So, we're a consistent buyer. So we've been able to take advantage of relationships as well as the macro environment of supply starting to increase. But we're higher volume purchasers with some of these home builders. So on top of the natural supply and demand dynamic, we definitely get some repeat business type of deals from home builders. So we do take advantage of that. Generally, though, we haven't seen the overall decrease that we might expect with the kind of recessionary and tariff-based policy fears that we may be feeling. The real estate markets, they don't price things also as nearly as fast as the stock market. It's a slower moving market. But honestly, it's very high quality right now. There's not a lot of underwater equity, which means that people's homes are worth less than their mortgages. That was very common leading up to the great financial crisis. And you had a lot of people that defaulted on their owner-occupied loans because the loans were at an inflated value. But honestly, there's so much equity that people have in the real estate market. I just don't see the setup for like a crash. So anyway, the prices aren't moving fast. And I think the supply and demand dynamic, while it's slow, it feels pinned where there's not risk of a crash, but there's also not runaway rampant price increases that we saw maybe 4 years ago. So I think the market is in a balanced state. It's just kind of slow moving right now. So I wouldn't expect a lot of depreciation across the market, and a lot of markets are still just going up. So it's very localized, and that's the approach that we take. But to your point, I think that it becomes more difficult to be discerning, and you have to really be sharp on how you underwrite rents and where you expect growth to occur, because it is a tougher environment to invest. But I think that we've got a pulse on all of the things that will hopefully make us successful investors going forward.
Absolutely. Very well said, Cameron, and great question. Let's move back down to the queue here. One from Steve. Why did the private credit fund shares increase in value? Cameron, I'll kick that over to you.
Yeah. So, we've been increasing supply and we've been maintaining the yield. And when we found that we had done our calculations after the payouts, that we had a little bit extra left over because the utilization for the quarter was good. Now, generally, we expect to maintain it around that $10 mark. Because with these short-term loans, there's not really the expectation of appreciation, but value can increase if the income was actually higher than the distributions, which is what happened. So I would, going forward, expect it to maintain around 10, but just that's how it can happen. But in the sense of like, what is the goal of the investment product? It's to maintain that $10 share price and pay all the income as dividends.
Fantastic. Yeah, great question. Moving back over here, let's see. Another good one from Raul. In the past, you mentioned that you were considering getting into small units or multi-units, for example, duplex, triplex, quadplex, that generate higher yields. Do you have an update on those types of properties? Could you please share the challenges you face getting into that asset class? Cameron, maybe I'll kick to you, and then Ryan, if you have any color to add as well.
Yeah. So first I'll address kind of the yield part. So as a company, our strategy has been to seek yield as well. As interest rates started increasing, starting in the 2022 interest rate hike cycle, from that point, we've been looking to increase yield on our offerings. And we have many options and choices on how to do that from an investment strategies point of view. Where we opted to focus our efforts for like that kind of path in or that stage in our company's history was to make the bets on credit. The private credit markets were really expanding nicely, that there was a good opportunity, that there was more banking regulation that was coming in that would be kind of a tailwind for the private credit markets and be a good time to be a lender. So that's the path that we took. And we put a lot of our investment and company resources into establishing these private credit channels. So with the income that we've been able to deliver at the 8.1%, I am happy with the direction that we took. There's only so many different options that we can roll out at any single point in time, and it's the one that we chose. So that's not to take away from the multifamily segment or the potential, but it's also market-based as well. We have a very scalable game plan within the single family residential to work with home builders in very select neighborhoods on the resale side. And we feel like we can deploy that across the whole country and like very opportunistically do that and invest well. And we've got the occupancy and a lot of the cash flow to kind of back up that game plan. Getting into multifamily requires a much more intentional rollout. It's a different set of resources. It's a different underwriting model. And there's going to be just like a different brokerage and transacting network also. That is, although they're like basically cousins and siblings of each other, there's still different business lines that require resourcing, much in the way private credit is also adjacent to the single family residential asset class, but it requires a different set of resourcing to deliver on generating income from those assets. So I do believe that that is still very much on the radar. There's a general housing crisis, call it, in the US, where rents and purchase prices are high, dwellings counts are low, supply is low. So there's a general push by a lot of state governments and local governments to push for what's called middle housing. So it's duplexes, triplexes, 2 to 10 units, ADUs, cottage residences, all those types of like interesting ways of rezoning. I think that those are all on the table, but just in terms of order of operations, we thought we could deliver the best yields and have a systematic program for investors with credit, as opposed to the assets, which require a little bit more of a longer ramp up in terms of like really delivering on the yields that we think are possible.
Fantastic. Awesome, Cameron. Thanks for walking through it. Ryan, did you have any color on the future of Arrived or roadmap?
Yeah, I think that, to Cameron's point, with the launch of the private credit fund, we're sort of deciding, do we want to participate in any real estate offering as an equity investor or a credit investor? And the interesting thing is that, based on the credit market right now, as Cameron mentioned, we saw the opportunity to focus more there in the short term. And so some of those small multifamily properties, you probably find them as financed properties within the credit fund right now. And then over time, as we see, opportunities in the market to participate more on the equity side as well, that's when we'd focus there. But just wanted to call out that those properties are starting to appear in the credit fund, where we're providing bridge or renovation financing on those types of assets.
Absolutely. Raul, definitely a great question. We're built on investor feedback. So hearing what you're interested in terms of different asset classes is super beneficial. And the team is grateful to hear. I think you've seen all the folks in chat. So awesome. And thanks for sharing there. The next one we have is from David. A little bit of context here. Our single family residential fund has been temporarily paused as we complete our routine annual filing with the SEC. But Ryan, perhaps do you have an update on when folks will be able to invest in the single family residential fund again?
Yeah, so we ended up filing our annual 1K, which includes our audited financials for the SFR fund through the SEC a few days ago. And then that should help us finalize the process of making the SFR fund back available. I suspect it will be open for investment within the next few weeks, maybe middle of May. So yeah, excited to have that back available. And from time to time, we may have that on an annual basis when we're filing our annual statements.
Absolutely. We'll be sure to share when it's live. And so appreciate obviously the interest in continuing investing in the fund. All right, moving back over to the queue. We have one from Jonathan. Cameron, I'm going to kick this one over to you. This is when Jake was walking through what returns look like, the 0.3%. Can you share more details on that?
Yeah, so as far as the gross change in the price, that 0.3%, it's not a typo, but it's also a quarter over quarter change. So if you were to roughly say multiply that by 4, then you have the 1.2%. And what we've seen from Q1 is that a lot of markets on the whole are flattish. And the SFR fund, it's a newer, it's composed of a newer set of properties. So, we use data aggregators and research firms to triangulate on kind of a comp value of what that property would be worth. So the closer that you are to the purchase date of a property, the more that the data sources are going to index to that over time, then the neighborhood movement will kind of diffuse that price. But it's a little bit of a circular argument when you're buying properties new, because like, what if you buy something that's really good value? It's underpriced. So before the day that they listed it, it might have been worth X, and you're able to buy it at 85% of X, so 15% off. So then what happens is that you buy it, then it resets the values. Like all the third parties will reset. It's like, oh, that must be the market value, right? Because it's a transaction is actually going to be the best source of it. So it's like, kind of, yeah, maybe on the aggregate, but any one deal might be different. So I think that with the SFR fund, because of how new the overall vintage is, a lot of the price appreciation hasn't caught up, but that's okay. This is a longer term game. Additionally, none of the properties have leverage on them. So to the extent that some have gone up and don't have the kind of more headline numbers that you might expect, a lot of times those are through leverage as well. So, all in all, not concerned about the composition. I think it's a really good, strong performing, well-diversified portfolio of like good deals, but their newer vintage dividend yields have been good, occupancy is good. So overall, not much of a concern for the SFR fund. But those are some of the dynamics going on of why the value change was like flattish quarter over quarter.
Fantastic. Thanks for walking through it. Jonathan, fantastic question. Let us know if there's any other color there. Cameron, I'm going to kick this next one to you. And Ryan, perhaps you have some color as well from this one. How do you see policy changes in Washington impacting Arrive's business models, both positive and negative? And the examples Stephen gave are home prices, interest rates, supply chain, et cetera.
Yeah, this is a great question. And a lot of intelligent minds will have different opinions on this. So probably the largest macro changes that I can observe today, without kind of forecasting too much in the future about like what could be, but more focused on what has happened over the last couple months. I see it most acutely in the home building market. So home builders have reduced their appetite for land. So that means that their future starts, because they're not going to go and get, buy permitted land and have starts and, according to their schedule, their future schedule, their pipeline is shrinking. So we anticipate that the supply of homes is going to be less, because the concern is that, regardless of how the overall tariff landscape ends up happening, if they're kind of here to stay, it's very likely that there's going to be more material tariffs on China. And China is the supplier of a lot of building material inputs, not just on the raw side. There's actually a fair number of places that have like raw material inputs, but in terms of like processed and manufactured inputs, China is still the king of like the exports. So things like plumbing fixtures, appliances, anything with an electronic circuit in there, those are all usually from like coming over from China. Certain building materials like marble and stone, there's quarries all over the world, but a lot of the processing is going to be happening in China as well. So I think that those materials are going to be a real cost to the builder's margin. Not everything, lumber still comes from Canada, and whether we end up having tariffs with them or not, maybe, but those are more raw material inputs, but not a lot of the home building process is not just pure raw material input. So builders will definitely be feeling it, even if the majority of places don't get tariffed. High likelihood that China stays tariffed for just kind of global competition reasons. So with costs anticipated to go up for home builders, what's going to happen is that they see a consumer that is already strapped for cash, and if there's already affordability concerns at those high interest rates. So that's why they're making the conscious decision to cut off their forward supply, or at least lessen it, so they don't end up with a bunch of hanging inventory. So all that means is that the prices are going to remain pinned. And this is a phrase that I used earlier, is that I don't fear the drop, because so many structural forces between the resale market, like everyone having equity, not wanting to give up their 3% mortgages, and then builders seeing high costs, but a consumer that can't afford more purchase price at these interest rates, everything is getting pinned. So there's fear in the market, but I think the headlines have more teeth than the reality. So I don't think the reality is going to change that much in the residential space. I think rentals will still be a good deal compared to purchasing. So I expect our occupancy to, I'm bullish on that. Rent growth, I think we'll see modest, but I don't think it's going to be runaway rent growth. Just it's tough. So kind of a lot of dribblings on like macro, but that's one of the main things going on, is that the new home supply is getting constricted. It's going to elevate the rest of the supply. It keeps comp prices high. So like if home builders started dropping all of their prices, the resale market would follow. But because prices are pinned high, the resale market's going to kind of index high to that too. So there's so many things that are just like, there's gridlock right now where prices aren't likely to like decline or run away to the top end either. So that's a lot of headlines, a lot of fear, but in practicality, I don't see too many parts of the puzzle moving significantly.
Fantastic, Cameron. Thanks for walking through it. I know we talk about wishing we had a crystal ball, but we have a fantastic team that's obviously looking at the market minute by minute. Ryan, did you have any color there before we move on to the next question?
I know that there was one question about how does maybe Arrive compare to other ways to invest in real estate? And I think that this might be a good time to kind of jump into that conversation, because when people think about investing, in real estate or alternatives to Arrived, I think two big ones. One is investing in some of the public real estate investment trusts or REITs, and then some of the public builders. And then the other is sort of going out and buying and managing rental properties on your own. When we think about the public real estate investment trusts or home builders, one of the points of difference for Arrived is that a lot of those public entities still trade based on market sentiment, and they don't really have necessarily the same return profile as underlying real estate, which one of the big benefits has been just the kind of stability, slow and steady, I guess, wealth creation is kind of what we've seen historically. Whereas as you start to invest in these publicly traded entities, they can still be much more volatile, day to day, month to month. And I think we've seen that in the public markets right now, where there's so much uncertainty in what is going to happen. All of that uncertainty leads to a lot of price volatility, which is not really based on the underlying real estate values or prices at all. And that's one of the things that really drove us to launch Arrive to begin with, is to be able to allow people to invest passively in that same way, but have their returns and performance track more closely to the underlying physical, tangible assets and houses. So that's one point of difference. And then in terms of investors who might be considering the trade-off of buying whole rental properties on their own, really Arrived is more of the turnkey, more passive, sort of hands-off way of doing that same thing. And for a lot of investors, the big benefit of investing on Arrive versus buying their own rental properties on their own, besides being able to tap into folks like Cameron and Jeff and our experienced real estate investments team, is really the ability to take the amount of capital that they would have invested on their own in an individual property and sort of spread that out across multiple properties and multiple geographic markets. I think for some investors, maybe they have a advantage in investing locally. Maybe there's, a specific location in the city where they live that they really fundamentally believe is ripe for change. And that may be a reason to, invest on your own. But if you don't have that type of information locally, or you want to diversify into other markets, maybe you live in a location today where you don't fundamentally believe in the real estate market there at this time, or you don't want to be participating in that local real estate market, it can be really, really challenging to invest in a market you're not actually living in right now. And so Arrived, helps investors diversify across today 65 markets for our rental homes. If you look at our credit fund, we're participating in even more markets. And all of that sort of allows investors to get the best of both, have returns that closely match the underlying asset values, but without all of the work traditionally involved in investing on your own.
Absolutely. Yeah, Ryan, that was a perfect time to wrap in that question. Obviously, folks have a myriad of different ways to invest: stocks, bonds, CD, traditional real estate, so on and so forth. So it's always good to be asking those questions when you're choosing where to deploy your funds, especially when it's for a considerable amount of time with a whole host of different variables out in the market. All right, moving back over, I'm going to kick this one to you, Ryan. Always great feedback and question here. Any chance of an automatic dividend reinvestment program? This would result in fractional shares, but allow our investment to grow. I'd love to do that with the private credit fund dividends.
Yeah, that's a great question. Today, many investors are reinvesting their dividends on a monthly basis back into offerings. So maybe they have investments in individual properties, the credit fund, and other offerings. All of those dividends are being paid to investor cash balances, and then they can reinvest them however they'd like. We would love to create a dividend reinvestment program directly, where investors are automatically reinvesting into particularly the funds. That model doesn't necessarily work as well in individual properties, but there's some regulatory constraints right now to allowing us to do that. It's possible that in the future we are able to do it, and it's something we've continued to look into. But for now, the only option for investors is to just reinvest from your arrived cash balance.
Absolutely. Yeah. Great feedback there. We'll be sure to share more details in the future. All right. Moving back over here. Cameron, this one's a great one for you. Are you going to have more properties in the West or internationally? Lori's curious.
Yeah, let's start with internationally. I think that there are a lot of good opportunities, and it's not even like the economics that get in the way of investing internationally as much as things like property rights, kind of the stability of a place to open up an operating company. Even if you're not going to be headquartered there, there's a lot of tax issues, then there's currency issues. Stable coins may help with that, but there's a lot to consider. There's so much good opportunity, I think, in the US, and like you're talking about, more properties out in the West. We've really only scratched the surface. $250 million worth of investment and offerings is a great start, but US residential real estate is 30 trillion. It's the single largest asset class in the entire world when you kind of partition it off by country and kind of asset class. But US residential real estate, there's no bigger classification of asset class in the world than that. So will we go international eventually? I don't preclude it from the future. I don't think that we're limited to US based real estate, but in terms of order of operations, there's plenty to get people invested in at home first. Then we can look at expanding geographically. As far as the West, yeah, definitely. I think that what we're kind of biding our time and timing the market a little bit more than fundamentally avoiding a part of the country. I think that certain parts of the West got pretty heated up during the pandemic time, and we invested in Arizona. In early 2021, we were looking at Phoenix and Tucson. Eventually, we thought that the prices got to a point where there was more opportunity in the Southeast. So we really planted a flag more so in Tennessee, in Arkansas, in Atlanta, North Carolina, those areas. So it's just kind of where the game plan took us. But with that said, as the market is kind of catching back up to where it kind of heated up to, now we're starting to see opportunities in markets like Salt Lake City. We're looking in Las Vegas. And I think as our funds grow, there's the ability to add more properties into them where, the dividend in of itself with the income, it may be lower, but in a mixed portfolio, then those appreciation elements start blending in quite nicely. So properties that I think any property can really exist as an individual offering, but a lot of our individual offerings are more focused on that balance of, okay, let's try to split where we get about half of it from income and half from appreciation, and pick the price points and rents where, and the market mix that is conducive to that. Investing in a place like Seattle or California is going to have a much lower yield, but especially if you can get some leverage on that, you have a real good chance to make money on the land, right? Which is really the part that really starts appreciating, but it makes everything else expensive. So it's an investment strategy. And as we have more investment products, there will be a larger surface area to take properties that make work in one capacity, but not another, and find a home for it. So that's, but anytime something is more expensive in of itself, it's always a little bit tougher to buy, right? So we see a lot of opportunity where there were good brand new homes that we could buy for $300,000 in growing areas, and that's kind of hard to turn down at the time. But eventually our investment strategy will find more corners of the map.
Absolutely. Yeah. Always if there's any other markets too that you would like to see, definitely let us know. We'd be anxious to hear where you would like to invest in. All right. A good one from Bill. Does Arrived roadmap include investing through retirement accounts? So this is probably one of our top asked questions. Ryan, what are your thoughts here?
Yeah, it's a great question. I think Jake also answered this in chat. For investors who have a self-directed checkbook IRA or retirement account today, or would like to set one up, you can already do so and invest through Arrive through that. Over the long term, what we'd like to do is allow investors to create a retirement account directly in Arrived, transfer assets in, and then be able to invest that way. There's some extra steps if you're using a current self-directed IRA. That can create some just more work in the process, but yeah, so that is definitely something on the long-term roadmap, and that we'd love to make available for investors.
Absolutely. Great feedback, Bill. We'll be sure to keep you tuned in on next steps there. All right, moving back over. I know a couple folks had asked about the raise on WeFunder. Can you comment on the WeFunder capital raise progress? Will there be another one? Perhaps, Ryan, we share the date that we're closing on this one and a little bit of the why.
Sure. Yeah. So for those who are new to that, we've raised a significant amount of venture capital, over $40 million of capital from some incredible investors in the business. And when we've closed our rounds, one of the number one asks from investors on the Arrive platform is to also be able to participate in equity in the company. And so we held open a small allocation for investors who want to participate in the round. Investors can invest through WeFunder. It's a separate platform for Arrived, but allows for investing in shares of private companies. And yeah, we're closing the basically the investing window, I think tomorrow. So we sent an email, I believe today, about that. It's something we've been completing here in the month of April. And then in terms of, will we do it again in the future? I think it's possible. We'd love to allow investors on the Arrive platform the opportunity to continue to build equity in Arrive, the company, as well. But we can't say for certain that we'd be able to. It really has to do with the dynamics of, timing of when we raise additional capital and whether we can hold allocations for investors to come participate as well.
Fantastic. Awesome. Let us know if there's any questions there. I dropped a link to the WeFunder page. I know there was some questions about, can I deploy what I have in my Arrived account over to WeFunder? So those are separate as it is to date. If you're receiving, let's say, dividends in your Arrived cash balance, you could withdraw those funds to your connected bank account. If you have the same connected bank account, you could use that and connect it on WeFunder, but they are separate. For folks that do invest via WeFunder, we will showcase that amount within your Arrive platform. That's a manual process on our end, so that won't happen in tandem if you invest in on WeFunder and then it populates in Arrive. It'll take a little bit of time there, but again, the round's closing tomorrow, so definitely stay tuned or jump in if you would like. A quick one, Ryan, since this one's like kind, and for folks on the line, Janice had asked, WeFunder is new to me. How does that work?
Yeah, so WeFunder is a separate platform from Arrived that allows investors to invest in equity in private companies. And so investors would need to set up an account on WeFunder. I think Korin had posted the link to our specific Arrived page, and then would participate there. But that's how it works.
Absolutely. And Janice, too, they have a resource, support@wefunder.com. You can always email support@arrive.com, too, if you have questions. We'd be more than happy to help. All right, moving back over, another good one. Does the PCR receive equity kickers in addition to origination fees and interest income? If so, are they distributed upon sale of the property, or are they held to increase the share value of the fund? Cameron, I'll kick that one to you.
Yeah. So the private credit fund doesn't receive any sort of like carried interest. Like Arrive doesn't have a carried interest in it. There's not really an expectation of appreciation from the underlying assets. So the strategy on those loans is that when we purchase them, there's the expectation of the interest income, and then we hold it until maturity. So we're not trading notes, and we're not really a fixed income trader in that sort of sense. You might do that with longer instruments like 10, 20, and 30-year bonds, but typically you're not doing that with 6 to 24 month instruments like we have. So that's why we position the private credit fund as a vehicle that produces purely interest income, or the dividend income is generated purely from the interest income, specifically on origination fees and other sorts of economic flows within that product. So the private credit fund is a purchaser of high quality loans, but we're not an originator. And there's a difference in that the originator, that's really the decision to extend credit. So a lender, is a bit of an umbrella term, but there's kind of two ideas within what a lender is. There's an originator who's making the very regulated decision to extend credit and write out the loan and the economic terms. The creditor is another part of the lending relationship, but it is the party that extends the money that is being borrowed. So the credit fund is much more akin to a lender in that the capital is being used to provide for the borrower's funds. And then when the borrower completes their exit successfully and pays off the loan, that capital comes back, and then we redeploy it into purchasing other loans. But that's not an origination activity because we're not dealing with the borrowers ourselves and evaluating and underwriting that credit worthiness of the project and the borrower and that extension of credit. Now we're doing a different type of underwriting, a very thorough underwriting of both the originator, the borrower, in the sense of like, who did you lend to? What is their profile? What's their experience? What's their credit report, their assets? Like, we look at all of that, but we're not making that actual decision to extend the credit. That's what the originator does. And that's a license activity in most states to perform that. So we're that aggregator of loans. So in that sense, between not having the expectation of appreciation, like distributing the income as the return on the investment, and then not being the originator ourselves where we're collecting origination fees, then Arrived makes a management fee, and then the investors get all of the net interest that's flowing into the fund, and that's how the economics work. So going back to the other answer earlier, we expect that the share price of this product will stay fixed at 10. There can be quarter to quarter like slight oscillations just from accounting and distribution math, but over the long run, that's the strategy where we pay out all the income.
Fantastic. Yeah, great question. Awesome. I think we have one more question in the queue here. Folks who are on the line, please keep me honest if I missed any earlier or ones that you wanted answered live with more context before we shut our virtual doors here. I know we're 13 minutes over, so Ryan and Cameron and everybody in chat, thanks for staying on with us. A good one from Steven. Some builders like Horton who have bought from are dealing with inventory. Is this helping get price concessions, especially since we are cash buyers? Oh, this is Steven. Steven, it's great to see you today. Sorry, I didn't recognize at first.
Yeah, so definitely cash buying, I think, is a big key because that's also certainty, right? And as far as the inventory that those home builders are dealing with, it's not everywhere, but certainly in some of the pockets that we're investing in, they're typically coming up to us with the kind of end of cycle inventory. So they see, builders kind of pre-sell their lots as well. And then all along the whole vertical construction process, they're selling it at different stages. So as they get closer to the end and they're like getting closer to that finished product and there's not an owner occupant buyer, then we start looking pretty attractive as a cash buyer to make sure that there's the certainty to get it off their books, because they also have a balance sheet. They have debt to manage as well and interest payments. So they got to keep their capital cycling fast. So because of that, and because financing is not cheap for neither owner occupants nor builders nor anybody participating in the economy, borrowing is expensive everywhere. So everybody's on like kind of a just in time type of schedule, which is reducing the forward inventory, and it's making us attractive as cash buyers, as you so like astutely point out that is a big key to it. So yeah, I'm happy with the valuations and the discounts that we're getting. I think that it's good value because it's not fundamentally why it's cheap. It's more like they're getting squeezed in the short term, and that's a buying opportunity. So that's kind of how I view what's happening right now, which is why a high percentage of the inventory is new home builds.
Fantastic. Yeah, great question, Steven. Great to see you hopping in here today. I think we cruised through all the questions. Cameron and Ryan, any not preparing remarks, any closing remarks before we shut our virtual doors today?
I'll just say a big thank you to everyone for joining, for investing alongside us, and for all the great questions in chat. Korin, Cameron, Jake, and Arrive team, thanks for supporting and running the show today. This has been great.
Yep. Likewise, a lot of great engagement, a lot of great questions, a lot of familiar faces as well. So appreciate all of the support, both today and throughout the years. And we've got a lot of exciting investment products coming up, both Arrived features and different investment opportunities. So stay on the lookout for that.
Absolutely. Cameron and Ryan, thank you so much for your time and prepared remarks. Jake as well, for our whole team in the chat today. You saw from a myriad of different teams, absolutely exceptional. For the folks that spent an hour and 16 with fantastic questions, thank you. We wouldn't be here today without you walking alongside us and investing. So thank you. I just want to quickly mention we typically host our standard webinars 2 days a week. Those are more intro focused, so feel free to jump in there and we will send a recording out today. If you have any other questions, feel free to reach out to support@arrive.com. You can use our chat function in the bottom right-hand corner of our platform. We are live on all social channels. The one we are most active on from a community perspective would be our subreddit. But I hope you all have a great rest of your day and happy investing.